Welcome to TP Talks, PwC's Global Transfer Pricing podcast series. My name is Dana Hart, and we welcome you to our episode addressing one aspect of the OECD's ongoing work to address tax issues arising from the digitalizing economy. In this episode, we will be discussing the recently released OECD Blueprint on Pillar 1. According to the Inclusive Framework cover statement, the aim of Pillar 1 is to adhere to the concept of net taxation of income, avoid double taxation, and be as simple and administratable as possible. Transfer pricing takes a prominent role in the application of Pillar 1, and we will spend time today discussing several key considerations for taxpayers. So with that, let me introduce the speakers joining me here today. First, I have Kartikeya Singh with PwC US. I also have Georgia Maffini with PwC UK and Stefan Debets with PwC Belgium. Stefan, you are the moderator for today's podcast, so over to you.
Thank you, Dana, and good day to all of you. I'm very pleased to have Georgia and Kartikeya with me on this very interesting topic. As you all will know, on the 12th of October, indeed, two blueprints were published by the OECD Inclusive Framework. Both concerned the digitalization of the economy, but if you really have a deep dive into these two pillars, as you might call them, their objective is quite distinct. Pillar 1, which we are going to discuss today, is with regard to, or is about reallocating profits and with installing a new nexus rules. Whereas Pillar 2 is actually, let me call it, a top-up tax or levying a kind of minimum tax. So the objective of two pillars is quite different. But in today's podcast, we are going to discuss Pillar 1. And we are not going to give you a high-level overview of what's going on. We're going to take a bit of a deep dive because we are having already some feeling that you might already be familiar with the high-level issues of Pillar 1. But we have identified three major issues, which are of some concerns, I would say, to us. The first thing is the scoping of Pillar 1. Who is actually in the scope, or what is in the scope of Pillar 1? The second one relates to the sourcing rules. What will be covered by Pillar 1? And the third one is with regard to segmentation. How should we segment? Does everybody need to segment? And all these things that go around with segmentation, whether or not you are obliged to segment or not. So let me turn to Kartikeya. What are your first thoughts here on these three elements?
Thank you, Stefan. All of those three elements and the three aspects that you talked about, Stefan, obviously are critical, that a lot of taxpayers were interested in. And the blueprint goes into a fair amount of detail on each of those. The first one is scope, obviously a critical question and a starting question for every taxpayer as to, determining whether they're going to fall within the scope of this new taxing right and the new income allocation rules of Amount A. So on scope, the blueprint has, the way I see it, a three-part determination. The first part is around business activity. So whether the activity and the revenues generated from that activity fall into what are called automated digital services, which are, services that are provided with minimal human intervention and provided over a digital medium, so something like the internet. And the second are consumer-facing businesses involving the supply of goods or services that consumers, use for their personal, consumption or use. So that's the activity part of it. Now, within ADS, I get into a fair amount of detail in terms of a positive list, a negative list, but also a more general principle to recognize the fact that this is an evolving business and an evolving definition. The second scope criteria is around revenues. And this, again, has two components. One is a global revenue test. So if your global revenues exceed a certain threshold, you're going to be within scope. Again, the threshold itself is not defined. There's some discussion around, phasing that threshold, starting with a high one and then progressively lowering it. And the second piece is around how much of the in-scope revenues are actually foreign revenues. So if those turn out to be de minimis, then, even if you meet all the other criteria, but you have very limited foreign in-scope revenues, you're going to be out of out of scope of these rules. And lastly, you have the exclusion. So certain industries like the extractive industries, construction, financial services are entirely out of scope by definition from these rules. The second aspect that you touched upon is around sourcing of revenues. Remember, this is about reallocation of taxing rights on a destination basis to market jurisdictions. So the blueprint actually gets into a lot of detail and has some very prescriptive and detailed rules on how revenue should be sourced to those market jurisdictions. And these rules are categorized by the industry, so by the sort of the ADS versus consumer-facing businesses, but then also gets into a lot of subcategories within the ADS and consumer-facing segments. So, for example, if within ADS you are categorized as intermediation platform services, then so for example, think of a company that operates an online marketplace connecting buyers and sellers. The revenues are intended to be sourced 50-50 between the jurisdiction of the buyer and the jurisdiction of the seller. For online advertising services, revenues are intended to be sourced to the jurisdiction of where the viewer of the advertisement is. And then finally, the last element in these sourcing rules is the use of a hierarchy of indicators. So for example, geolocation or IP addresses to pin down the location of those viewers or buyers and sellers that I talked about. At least in this case, actually, it'll be the viewers of the advertisement in my example. Finally, segmentation, which is a big question for a lot of taxpayers as well. The question whether when you actually get down to calculating amount A, do you have to do that on a group-wide basis, or would you do that for specific segments? And here the rules get into what they define a segmentation framework, relying on revenue thresholds and certain other criteria, which they call segmentation hallmarks, to determine these related questions, whether the amount A has to be determined on a segmented basis. If it has to be determined on a segmented basis, can the company rely on the segments that are actually reported in their financial statements, or will they actually have to rely on certain alternative segments specifically used in the determination of amount A? So a lot of detail and a lot of things for taxpayers to work through in these blueprints.
Thank you, Kartikeya. And it does seem to me that the OECD is always mentioning that the ambit of the project must be simplicity. But when I look at what I'm hearing, becomes quite complex. Georgia, what are your opinion on these three factors: scope, sourcing, and segmentation?
Thank you, Stefan, and hello, everyone. Yes, Stefan, I really like your question starting with this idea that we should reflect on the complexity of the project. For example, in scope, if we look at, really what is happening to our clients who are trying to understand whether they are in scope or not, and for many, whether they are automated digital services or consumer-facing businesses. And here we find already some challenges. This is not surprising to us in the UK because the same exact issues are coming up with the digital services taxes, because digital services taxes, in the same way as Pillar 1, are trying to legislate around a business model that keeps on changing, and that business models that are very heterogeneous across taxpayers. So it's very difficult for the legislation to legislate precisely about those ever-changing business models. Just to give you an example, it might be that a taxpayer sells digital services, but then the question is, are these digital services automated? And hence we are in the category of automated digital services, or are these digital services more bespoke? And hence we are in the consumer-facing business category. Now, this is not an easy question to answer. It all hinges on whether that service is automated, and automated is about how much human intervention there is, for example, on the platform. But who's going to tell us whether that specific amount of human intervention is enough to classify you as a consumer-facing business, for example? So you see, that really there are some very difficult questions that are going to be very difficult to answer and to police for the tax authority. And we know by experience, this type of questions will create a lot of uncertainty for our clients. On sourcing rules, maybe just a quick thought is, again, that comes from our experience with the digital services taxes. It might be that a sourcing exercise is very compliance heavy for some of our clients because they would need to use data that is generally not being used for tax purposes. And Kartikeya, you mentioned geolocation. Geolocation is not the type of data you generally use in your tax computation. So you will have to first work maybe with your engineers, maybe with third-party distributor to understand where the data is, what the data says, and then you have to set up systems for that data to talk to tax data. So in our experience, at least for DST purposes, this could be a very heavy exercise, very costly exercise for our clients. On segmentation, Stefan, that's the classical design feature that could make really pillar one very complex to understand and very complex to comply with, because you might be in the situation where you need to segment, say, by business line and then also by region. So the question here is to reduce the complexity of this exercise. Maybe we want to leave the choice to the taxpayer, but this is still an issue that is very open in the blueprint, where the debate seems to be is around whether we want geographical segmentation or not. This, as I said, could complicate the compliance with the pillar one, but it could be useful because geographical segmentation will allow you to redistribute amount A within the same region. And if the profitability of markets within that region is not too heterogeneous, then you would not subsidize markets with a low profitability with funds that essentially come from markets with a high profitability. So again, some advantages and some draw fine segmentation.
Thank you, Georgia, for those insights. So I keep in mind complexity, additional burdens, and also several drawbacks from this amount A approach. Let us turn now perhaps also to amount B, because pillar one consists of an amount A, which is purely formulaic, and then an amount B, which, according to the blueprint, is within the arm's length principle and kind of creates a fixed return for routine marketing and distribution activities, or baseline marketing and distribution activities. It looks to me as this could be easier. It looks to me that it could be more simplistic. Then, of course, there's also the relationship between amount A and amount B. Is this really something that is more simple? Georgia?
Stefan, I think you're being cheeky with this question. And so amount B is so easy that it seems that there isn't much of an agreement at the OECD on amount B. So it's true that at first sight, amount B really seems very intuitive for transfer pricing professionals, is a return on baseline marketing and distribution functions, a return that we can calculate with a standard benchmarking exercise. So essentially what we would be doing with a fixed return is set up a trade-off. From the one hand, we have a fixed return, which is certain. So it gives us simplicity, it gives us certainty, but on the other hand of this trade-off, we lose precision. We lose precision of exactly what we should give to that specific, say, limited risk distributor. So now suppose we go off with our benchmark study and we find a specific return. On that return, we know that some countries do not agree. Okay, so that's when the uncertainties start. That's when maybe we have to think of a range of returns and where exactly we are going to go back to the uncertain position. And so if we don't agree on a fixed return, then we really lose the certainty and the simplicity of the exercise. And we are really left with a fixed return that, for example, we cannot adjust in the case of an economic downturn. That's why we think the exercise is much more difficult than what is forecasted. So once there is no agreement on what exactly that fixed return is, we are really losing all the advantage of having our amount B, and we are left with the disadvantages that we know very well, especially given we have seen in COVID. We need to say that if designed well, amount B could really be a good design feature that ensures certainty. But the problem is the political agreement on the number that comes out of a benchmarking study, which we know from a benchmarking study, you don't get the returns that some tax authorities would really want. Okay, the returns from the benchmarking studies are limited. But I'm sure Kartikeya has lots to say on this very point.
Thank you, Georgia. Indeed, Kartikeya. So I've heard from Georgia, and from what I know myself, it's still, or at least it is said still to be within the arm's length principle. But if I hear Georgia well, there seems to be not really a stick to all the business models that may be around there. So is this the end of the arm's length principle as we know it?
Yeah, that's a great question. And I will say, just like you were being cheeky with your original question to Georgia, I think Georgia was being a little cheeky when she finished by saying she's sure I have a lot to add. I actually don't have a whole lot to add to what she said. But I will say I do have a few thoughts. And it's worthwhile going back to, what the overarching principle or purpose was for amount A versus amount B. And Georgia touched upon that, where amount A was more about really a fresh look at the allocation of taxation rights and the income allocation rules that are applicable so as to give market jurisdiction. So in other words, give more taxing rights on a destination basis. Amount B had a different purpose. It was not a departure or a deviation from the arm's length principle, but intended to be a more simplified application of the arm's length principle in those situations where it lent itself to the possibility of simplification. And the promise that was put up was the avoidance and removal of disputes. And so there was this perceived benefit from the side of both taxpayers and taxing authorities. So one of the implications of that, which is different from amount A, is that there are no scope criteria that apply to amount A, at least in principle. There's scope that applies to the nature of activities, etc., that would fall within amount B, but not the scope criteria about businesses on the whole falling within the scope of amount B or not. So that's one difference that comes from, the overarching objective. The other thing, if one looks at it as a simplification of the arm's length principle, and as a transfer pricing practitioner, what I see that as is basically taking away some degrees of freedom that we as transfer pricing practitioners have always accepted and accounted for when we apply the arm's length principle, which is that you have the flexibility to structure contracts in a number of different ways. You are able to allocate risks in a number of different ways, subject to the caveat that there's adequate substance to back up that allocation of risk, and that's at the heart of all these limited risk distribution models that you see. And you have the flexibility to choose different types of profit level indicators when you're trying to benchmark the profitability of sales, marketing, and distribution functions. And a lot of that flexibility via this simplification would be removed via amount B, because the amount B would dictate that, the target return has to be determined based on a return on sales, EBIT divided by sales. it has to be a certain level. So in other words, it has a certain assumed allocation of risk rather than letting that be flexible and governed by intercompany contracts. And so it is a simplification. It is still tied to the arm's length principle, but it is a much narrower application of the arm's length principle, which is the trade-off that Georgia talked about between simplicity and precision. So I don't see that as the death of the arm's length principle, but an overarching theme that is true for all of these, some additional guardrails and constraints being imposed on the application of the arm's length principle. And the last thought that I wanted to share was that, to me at least, it seems that even though there may not be agreement, multilateral agreement on this, once this conception and this framework on the amount B is out there, I think it may lend itself to unilateral adoption by countries, either through a mechanism or sort of a menu where they expect to see certain kinds of returns by industry and so on and so forth. And we have some examples of that, not exactly like a true amount B, but more in the form of like safe harbors and stuff. And, you know, when I look at the Australian regime, where they have certain kinds of returns for certain kinds of distribution functions and industries, it reminds me, you know, there is some resemblance to the amount B framework.
Thank you, Kartikeya. Thank you, Georgia, for these insights. What I hear from you is it's simpler, but it's less precise. And Kartikeya also used the word disputes. And when we browse through the financial press, the tax press, we see issues with regard to safe harbors for amount A. We know now that amount B is a simplification of the arm's length principle, but less precise. What about, we have also seen that amount A is really complex and new nexus rules, new allocation rules. Coming back to Kartikeya's points with disputes, are there any mechanisms to avoid these disputes or to resolve those disputes? Because in former negotiations, there were discussions about arbitration, but that was always a no-go. So what about these resolving or avoidance of disputes, preferably in advance? Kartikeya, perhaps.
Yeah, I mean, it's a great question. And the blueprint actually devotes a number of pages, I mean, pages upon pages, to actually talk about a completely new framework and a process that for amount A, and it covers both amount A and amount B, but amount A to me actually presents a completely new kind of challenge, because historically, when the basis of income allocation and taxation rights were the separate entity concept and the arm's length principle, the dispute resolution mechanism and framework that we've all, you know, grown accustomed to, which I think any practitioner would admit that it's not perfect, but at the heart of that dispute resolution process are these bilateral arrangements and the bilateral mechanism, because the key to income allocation and the key to income allocation disputes are intercompany transactions where the counterparties are identified and known. So if you have an adjustment or a dispute around the income reported on one side related to a particular intercompany transaction, you have already identified the counterparty and the relevant jurisdiction on the other side for that dispute. When you have a mechanism and an income allocation principle or rule of the type that amount A is, which is somewhat like an element of, you know, apportioning the overall profitability across multiple jurisdictions, that existing dispute resolution or dispute avoidance framework simply doesn't work, because it's not limited to 2 jurisdictions or 3 jurisdictions. It has within its sweep multiple jurisdictions where a change in one side actually has a ripple effect on the other, you know, on multiple other jurisdictions. So there is acknowledgement, and the blueprint, like I said, devotes a lot of space in terms of envisioning this brand new architecture, which would look towards, and there's, you know, talk about review panels and so on and so forth, where every aspect of amount A calculation and determination for a particular taxpayer would be reviewed by a number of countries simultaneously. So it's there, but my immediate reaction is that it is ambitious to say the least, given our experience with the existing dispute resolution mechanisms. This would involve something that we have never seen and will need to be built from the ground up. So it addresses, at least in principle, the higher scope of disputes, but I'm not sure it necessarily gives everyone the confidence that we can have something like that, and it's going to be truly viable.
Thank you, Kartikeya. Ambitious indeed. Georgia, do you think it has a chance of success, this new binding dispute resolution and avoidance?
Look, Stefan, I look at it from another perspective, if you like, is that Pillar 1, without an effective mechanism of dispute resolutions, will not work at all, because there are so many different topics and issues around, even only around Amount A, that where we can have disputes, and not only bilaterally, as Kartikeya said, but multilaterally, that I don't see how Pillar 1 can really work without this mechanism. But we are left with a very big task. So we have to have this mechanism, but whatever we are going to think about, it's going to be very difficult to set it up at the very beginning. And so maybe this goes back to some of the proposals at the OECD, whereby you think of starting this whole exercise on Pillar 1 as, on a small group of companies before we roll it out to a large number of multinationals.
Thank you, Georges. And now perhaps a little bit of forward looking. And the European Commission has already put down a thread that, well, first it was if there's no agreement by the end of 2020, we will go on their own. Now, because of the COVID-19 pandemic, of course, the deadline has been extended to mid-2021, but still the European Commission has still repeated that if there's no decision or no unilateral decision or consensus by mid-2021, we will go on our own. So looking forward, and also perhaps what can we do? How can we be of assistance? How is this going to work out if there is no consensus, if there is a consensus? And what can we actually do to alleviate a bit the burden and the complexity for our clients? Georgia.
Stefan, yeah, I think this is really the question. And I think that from now on, there won't be any status quo. It's either the OECD, Pillar 1 and 2 in some form, or more unilateral or regional actions. So we have to be prepared for this new world. How do we prepare ourselves? Already understanding the thinking behind Pillar 1 helps understanding how the world could be in a few months or years. And so I think that although there is a lot of uncertainty on whether Pillar 1 and 2 will become real, I think it's very useful to understand, for example, what is behind Pillar 1 to understand what the future might look like. And on that, clearly, running your numbers through some of the features of Pillar 1 is very important, is very key. It has been very important for us also to better understand Pillar 1.
Thank you, Georges. And Kartikeya, your 2 cents.
Yeah, I totally agree with Georgia. And if I were to take a taxpayer perspective, what does one do with, in the face of all of this uncertainty? When I step back and think about, the impact assessments that are out there, there's one by the OECD and there's several others as well. The one thing that does come out is that under some broad assumptions about these design features, that impact from Pillar 1 is still relatively muted. And what that means is that, for the most part, your income allocation outcomes are going to be shaped by the existing rules to a greater extent than these new rules, at least under most assumptions. Yet, we talked about if these rules are adopted, and there's the prospect of now, once you have these extreme detailed design features out there, the prospect of some version of them being adopted either on a multilateral basis or on a narrower basis among a more limited set of countries. And we've talked about how they do impose a lot of additional complexity, a lot of additional compliance burdens, prospect for uncertainty and disputes. And for certain taxpayers, notwithstanding that macro effect that I talked about, that the effect is likely to be muted and small, it is like, for certain taxpayers, it may in fact impose a somewhat significant constraint on how the existing rules work and govern the income allocation outcomes. So where does that take us? It takes us exactly where what Georgia said is the best way to understand the implications of all of these aspects, these rules, this complexity, is to try and model it out for your business using your data to the best extent possible. That will, first of all, give you a much more precise picture of what the new world is likely to look like, and then also help you understand which particular design features are likely to be the most problematic and most burdensome.
Thank you, Kartikeya. Thank you, Georgia. So in sum, the genie is out of the lamp, and apparently it won't go back in, because if I listen to you guys, we have the threat of unilateral measures. If there's no multilateral consensus, we have the EU, as I indicated, going on their own. And of course, for taxpayers, look at your figures, look at your data, look at what is important for you and how you can perhaps model, how you can perhaps tweak some of these issues. With this, I would like to thank you, Georgia and Kartikeya, for this most enlightening talk about Pillar 1, Amount A and Amount B, and the dispute resolution, or perhaps not dispute resolution, as we will see. Thank you very much. Over to you, Dana.
Thank you, Stefan, Kartikeya, and Georgia. And thank you to our listeners. If you have any questions about this topic, we encourage you to reach out to your regular PwC transfer pricing contact for immediate response. Thank you for listening. Stay safe and healthy.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.